The Portland is Home team talks real estate. Whether you live here or you're on your way, Audra and Andrew Galler work hard to welcome you home. They make the whole real estate process attainable, educational, and fun. After all, it is the biggest transaction of your life. The Portland is Home team talks real estate. I'm Michelle Odell, your host. And now, Audra and Andrew Galler.
Hi, Michelle.
Good morning.
Good morning.
We have another guest here for the Portland is Home team talking real estate. We've got Todd Gettison. He is a mortgage broker with Vantage Mortgage Brokers, a home loan experience designed for you. Todd, tell us a little bit about yourself, and then we're going to get into Andrew Galler's Market Minute.
I'm an Oregonian, lifelong Oregonian. Was born in Portland, grew up outside of Salem in a small farming community. Went to the University of Oregon, met my sweetheart there, followed her to Portland, and here we live. So I've been in mortgage since 2002. Really, just kind of a geek on it. Love it. It's a fun life.
And you help people. We were talking about this earlier. Everyone I'm looking at right now, you all help people with the American dream. Finding a place to live, finding a great way to pay for it. We're going to talk all about it. We've got great tips. We've got history and why are these things happening? We're going to talk about a little bit about how inflation is changing because today is November 10th. This will be published on Monday, November 14th. So this is all happening right now, and we're going to talk about it right after. It's Andrew Galler's Market Minute.
We just had a podcast not too long ago, so not a whole lot has changed, but since we're in the season of the Thanksgiving and the gratitudeness, I thought I would talk about just some gratitude stuff. And one of them is I'm grateful, Todd, you had time to come and join us. Todd, we've been working with you, I forget how long, on and off.
Forever.
10 plus years, forever. 20
Probably
million
since
years.
you started.
Yeah,
Yeah.
pretty close. Yeah.
Long time. And one thing that strikes me about it all is that's exciting about having you on in general and specifically about this show and this time right now is how much things change and how quickly. So, for instance, before we began the show, we were talking about my Market Minute, and I was going to talk about how not much has changed in the last week or two since we did the last podcast. But I am looking up charts, and inventory right now, as of today, is 2.5 months. I think it was 2.3 months a week or two ago. And that inventory is up 333% from this time, November 9th, 2021, which is a staggering number. However, keep it into perspective, 2.5 months historically is not awful. One thing that's occurred to me, I forget if I said this last month, is that, and Todd, I'm curious to know your thoughts, is one thing we think about, articles I'm reading, things I'm thinking, moving forward about this market. One conversation I'm in all the time is, are we in a crash? What's going to happen? Who knows the future? And all that is there's a ridiculous amount of people who have refied or bought with historically astronomically low interest rates, which I would argue may, in our future, confine or limit or put some bookends on how much inventory possibly will come on. There's a lot of people who may say, you know what, I'd like to keep my 6-7% interest rate and not sell and be exposed to 7+% interest rates. So, all these things, the market of real estate seems like it's going to be one way for the rest of our lives. And then whammy, in an incredibly short, relatively speaking, amount of time, this thing just upends itself and gets topsy-turvy, that we're in an environment where inventory can go up 300+% in a scant 12 months is insane. So that's the Market Minute. Inventory is rising. What I'm reading is that there's going to be a relatively large adjustment in some of these markets. Phoenix, Las Vegas, I'm looking at you. Not as much in Portland. Time will tell if that's true or false. But everything I'm reading and seeing right now is appreciation will slow to a crawl, will be a plateau for the foreseeable future. Quarters 1, 2, probably 3, 4 next year. And then we'll see what 2024 brings. We're seeing, just announced this week, all the online platforms, Redfin, Opendoor, having mass layoffs because the deal activity, the amount of transactions happening, is slowing for all of these reasons. And that, my friends, unless you guys have some questions, is the Market Minute.
Yeah, okay. Now you wanted to talk about history, Andrew. So specifically,
as everyone in the listening audience knows, because they care about me, right? I was a history major in college, right? Fascinating.
okay.
Who cares? I think that more interesting than me is the last 12 months. I mean, question for Todd. Were interest rates 12, 14, 16 months ago? Where are they now? Why? What's happening?
Tell us what's happening.
Yeah, so I would say that I made a point right before New Year's Day of this year, the end of December, to kind of take a look and take stock on where things were at. We were starting to see some rumblings. Interest rates at that time were 2.99% on a 30-year fixed, 0 discount points, blah, 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 owner-occupied purchase, 720 credit, all the disclaimer stuff I have to put in here. And the point being that they were at 2.99 at that time. And now, today, they're at 6.99% for that same loan through our network of lenders. Okay, so, I mean, what a phenomenal ride, 4% higher. You know, when we take a look, and I think earlier you and I were talking about, you know, where does the rubber meet the road? The rubber meets the road is monthly payment, right? So at a $625,000 loan, that's a $1,500 a month difference for the same house. On a $300,000 loan, provided you can find something available for $300,000 and or lucky enough to have a large enough down payment or whatever, you know, that's a $730 a month monthly payment difference. So when we talk about why has the market slowed, the answer is because the demand has been sucked out of the market. And to that point that Andrew was making when we were kind of on our offline conversation about, you know, why would somebody with a 2% interest rate want to put their house on the market and accept a 7% interest rate? What's the trade? What's the driving factor? The things that move people are, you know, they're having babies, they're getting job transfers, they're getting divorces, they're outgrowing their house, they're, you know, all these things are still happening, but those items aren't large enough and important enough to drive a $1,500 a month in increase in payment in most cases. There are some that there are, and those are the people that we're seeing. So, you know, go back and take a look at that last 12 months, and it's been a meteoric rise, and there's a lot of questions now. Where's it going? Is this another bubble? Is this all these things that you're hearing the wolves in the media throw out there so they can sell their advertising? And we can get deeper down into that a little bit later in the conversation. But right now, really the big difference is monthly payment and affordability.
Yeah, how many dreams have you squashed in the last couple of months?
I was joking with my wife last night as we got a new conversation open with somebody who wants to buy a house, and maybe we had the conversation a year and a half ago or something like that, and everything's great and they're real excited, and then I show them the numbers and then they go silent on me. So you know, the people that really have to do something kind of bite it and go through it and understand that this is a spot in time. And, you know, the beautiful part about right now is there's some flexibility with the seller there. You get a chance, as I think Andrew said in one of the previous podcasts here, hey, God forbid you get an evening to sleep on the decision.
I heard somebody recently say, it was a really interesting conversation about all of this. And they were saying, like you said, Todd, what really matters is the monthly payment. And so if interest rates go up, they can afford less house, et cetera, and so forth. But I've heard some people say, don't not buy because the interest rates, because prices are adjusting and you could probably continue to get the same house that works for you, higher interest rate, but lower price than you were going to spend. Also, will interest rates come down in the future? Will they? I saw an article in the New York Times this morning about inflation seems to have sort of leveled off, if that's true or not. And will interest rates adjust slightly next year, the year after? And you can always, you know, refi again. I don't know if we'll ever see those historic lows, but Todd, what do you think about that?
Let's talk about inflation for a minute, kind of how the measurement works. The measure of inflation that the Fed likes to use, the Fed being the person that's raising these interest rates and trying to get a hold of inflation, the measure is the CPI that came out this morning. It came out lower than expected at 7.7%. Down from 8.1 or 8.3%. So there's some really great news this morning. The timing of this podcast is just amazing because here we are now with what looks to be somewhat of hopefully a crest on this interest rate and inflation battle that we've been going through. Mortgage-backed security bonds, which are what drive interest rates, their price is up 169 basis points this morning, which means that interest rates are falling just as we speak. As we're talking right now, mortgage interest rates are falling. We could see a quarter to 0.3% better in the interest rate from yesterday to today. So instead of 7%, maybe 6.75, 6.625, somewhere in that range. So the movement's afoot. But what we also need to understand about these index that are out there, they're an ad over time. So it's a 12-month rolling ad. So let's say last month it was up 2. The month before that it was up 3. The month before that it was up 4. Now we're down 2. We take and add those up over a 12-month period, and that's what gives us our reading. So it's a lagging indicator of where things are going. So as we look forward and we look into first quarter, second quarter of next year, we've got some people that are very well respected in the industry. A person by the name of Barry Habib being one of them, saying that he believes by start of second quarter of 2023, interest rates might be below 5.
Really?
And just based on the way things work. Now, I don't have a crystal ball. I'm not willing to stick my neck out and say that, but his logic, the way he lays it out is very sound. By the way, this morning I watched a video before we got on here, and he patting him, so he's breaking his arm, patting himself on the back about being able to call the turn. But it's kind of fun to think that guess what, we could be headed towards something that is the light at the end of the tunnel rather than that train coming at us.
CPI, would you define that, please? You mentioned, put context on that, because I don't know that everyone knows that.
So Consumer Price Index is the Fed's favorite measure of inflation. And really what that does is take different industries and their price increase over the last period of time, last month, last 12 months, whatever, and kind of averages it out. What the Fed likes to do is pull out and go to the core reading, which removes housing and energy, okay, because they're volatile, or food and energy, one of the two, I don't recall exactly. But the point being that they're looking at a core reading that's around 6.2 today. Their target for that is around 2%. So that's where they're looking at, and the Fed is saying, just so you understand, inflation, why is inflation bad to long-term interest rates? And I think we need to answer that question before we go any further. And the answer to that question is that think about if you and I enter into an agreement and I'm going to pay you 3% on money you gave me every year. Okay, so now next year, with inflation being 8%, you just lost 5%. In other words, you're getting 3% on money, and the cost of your bread had just went up 8%. So every year that goes forward, the worse our agreement is for you, right? So that's the way it works with a mortgage-backed security bond or a government bond or something like that, is that you're building in a loss over time because the cost of goods and services are going up faster than the interest you're earning on your investment. And so why is inflation bad to bonds? It's because you're entering in this 30-year agreement on money at 3%, and it's going up 8%, the costs are, so you're losing 5% every year for 30 years, you're the sucker, right?
Mm-hmm.
So as we come out of that conversation and say, well, that's where people start selling mortgage-backed security bonds or bonds, and they're like, I got to get out of this, I got to get into something else. And that's where we end up with an erosion of mortgage-backed security bonds, and it's got an inverse relationship with interest rates, right? So interest rates go up when bonds go down, interest rates go down when bonds go up. So when I say this morning that the mortgage-backed security bonds up almost 170 basis points, that just means that people are liking bonds and people are investing in bonds, and therefore we've got the reverse happening with interest rates that are going down.
Well, one thing I found interesting back in the 300-year span of incredibly low interest rates, I mean, it was like that for a very long time. They said inflation's over for the rest of our lives. And there were a lot of people who were in retirement zone for whom that didn't work out well at all. I mean, these things, there's always winners, losers. It's not a black and white deal. Does any of that matter or have any effect on this conversation, quotation mark fingers?
Well, it's that double-edged sword. We love the idea of getting an interest rate on our automobiles or our house that are just so remarkably low that your grandpa's blushing, right? But the bad news is that what's the return on that investment? What's when you park your money in your money market or your savings or in these different vehicles, what are you getting back? And right now, well, we're getting pretty good return on some of that money, right? In those comparatively speaking, where it was 1/4% that they would pay you annually. I mean, it's almost like put it in a coffee can, right? But
Exactly.
now we're looking at 4%, and you will see a lot of people diversifying their retirement accounts and different investments and really parking money in bonds just to avoid the losses that we're seeing in the stock market, but also take advantage of that 3, 4, 5% looks really, really attractive compared to a 30% loss, right? So
Hmm.
the answer is it is a double-edged sword, and that's the magic of trying to, I certainly wouldn't want to be in one of those Fed chairs and trying to manage and navigate this situation right now, especially coming out of the pandemic with all the, the money that was put out there to get the country off of their feet and back up on the feet. So it's a conversation that has a double edge to it. The succinct answer is that if we get control of this inflation bug, we can expect more reasonable interest rates, and that will parlay into more affordable housing payments. And that will, I gotta help to think, but people are getting married, they're getting divorces, they're changing jobs, they're finding reasons to move. They want to go to this school district, they want to go to that. And my concern is the pent up demand that we're building right now. And the housing shortage that we have. We don't have enough housing for everybody in America. And we certainly don't in the Portland area with the people that want to be here and live here. Right. So we get rates back down. What does that look like for the demand now meeting a still very low, historically low supply? And are we right back?
Yeah, because I remember, we all do, 2008, 9, 10, 11, 12. And I remember in 2011, 12, we were having conversations about deferred home creation. A lot of people, it's so hard in a depreciating market at that time, those 4 or 5 painful years. Why would I buy a house now that's going to be worth less tomorrow? And the only people who ended up buying had an answer to that question. There were only a few. I would ask buyers this: why would you buy right now? Let's get this all out, because you're going to lie awake while we're going through this anyways, and either you'll close a deal or you won't. So why would you buy in a depreciating market? And the only people who would close a deal would have an answer, one of these 2 or 3, because I want to create stability in my lives by having a payment for my living situation. You can call it rent, you can call it mortgage, but we're all paying to sleep somewhere every night, no matter what the economy is doing. So if you wanted to create stability and certainty in your life, you would buy a house, you would do it, even though tomorrow it might be worth less. And the other people wanted to, it was all really, the answer was stability in your life. If you want to paint your walls any color you want to fix it, you want to fix it up, you want to bring it, you want to do whatever you want to your domicile. That's why you would do it, regardless of the perceived or real economics of it. And I think the reason I'm dovetailing that into this right now is because, is right now an opportunity. And I think in 6 or 18 months, we'll know. But I remember really coming to the realization around 2011, 12, I had no idea if I was going to be right, that there was such pent up demand from such a long time. I would argue that because of the urban growth boundary, because of lots of other reasons, lending practices, they're not building anything here of note. They're building some things, but not a lot. It's going to, I can't imagine a scenario where, Todd, what you kind of touched on doesn't occur in our reality of demand coming back the minute we either A, become acclimated to this new abnormal,
Right.
or B, things change and trend in the other direction, or both.
Or both, right?
And to that point is why so many people are saying, if you're a buyer and if you were trying to buy last year and you got blown away by the idea you had to be $80,000, $100,000, $120,000 over asking price, the real deal last year was the interest rate. Right now, the deal is the deal. And that's the thing that I'm looking at is you've got a seller that might be reading the news. They might be on one of those sites that are pitching a bubble at you. You don't know where their mindset is. They've got 2 houses. They've got an empty house. They've got whatever their motivation is. And I'm not saying right now that now's the time to go in there and lowball somebody. What I'm saying is go in there and get a deal, right? And that deal, when we dovetail that into affordability, probably leads us into one of the hottest topics right now, which is buy down. How are we buying down that monthly payment for the buyer? What tools do we have available to do that, either permanently or temporarily, right? And there's a lot of these things that are available.
Can you explain buy downs?
Yeah, it sounds so easy.
Yeah, I think the easiest way to put it is, so let's talk about permanent buy downs, because it's a simple concept most people get, and that is called what's normally termed as discount points. So let's say the going interest rate today is 7%, just for round numbers. And you're not paying any extra fees. You've got your normal fees, your third party costs, your lender fees, processing, underwriting, those type of things, but you're not paying any extra fees for that.
We call those closing costs and prepaid expenses, right?
Exactly. Closing costs, prepaid expenses, and third parties out there, right? Title, escrow, appraiser, inspector, all those things. So now we boil those out. We just take those out of the picture and we say, just what are we paying to the lender, right? Well, the lender says you can have 7% for no additional charges, or you can have 6.75% for a fee that's about 1% of the loan amount. Okay, so if you pay an extra $7,000 in fees, you can get a quarter better to the interest rate, which is going to save you $90 a month. And over time, the backwards math is that monthly savings divided into that additional fee. If you're going to be in the house that long, it makes sense, right?
Mm-hmm.
How long does it make sense? How long does a person need
what
to
is the magic number?
Ish.
We're going to have to do a little math, but I can do it on the side here.
Oh, carry the one.
So let's say we've got a $400,000 loan, right?
Okay.
At 6.75 for 30 years fixed, not including taxes and insurance and anything else. So that's basically $25.95 a month, right? And then we've got a 7% interest rate on that same $400,000 loan. So that is $26.61. So $26.61 minus what is it? $25.95. All right, $66 a month. Into our $7,000 extra costs, 106 months. So you're going to be there 8.5 years to pay that money back.
Okay.
And
But how much do you save over 30 years then?
Well, after you paid yourself back, you're going to have, what is that, 20 some years, 22 years to pay yourself back, 21 times 12 times 66, $16,632. So this kind of belabors that point of the math. The math is always going to lead us. And our mantra at Vantage Mortgage Group is math and facts. We're not selling you. We're looking at math and facts, right? What are the facts that, well, I only plan on being in this house 3 years, Todd. My company's going to move me.
So don't do that.
Well, but I think that it's not black and white, one and done. I think some people, the payment's the thing. Like they can't, if that's going to break them to go higher. And by the way, we find out, or we're able to negotiate more closing costs because on this case study you described, the $400,000 house at 7%. Let's throw a dart at the wall. Would closing costs be between like $9,000 and $11,000?
Yes.
And then if you buy it down for a quarter of a point, and let's just say it's $10,000, let's average it. What would that buy down make the $10,000 closing costs grow to?
11,000 plus 7, so
$17,000. So maybe we can, in lieu of repairs, negotiate the seller contributing more money.
Absolutely.
So then it doesn't cost the buyer anything if we're able to negotiate. This is an option, right?
Okay.
And this is the beauty of this new reality, right? This new reality is the old math that we talked about. That's the traditional math. Right now, the payment is the driver. Right?
Yeah.
The payment's in the driver's seat. It's no longer the conversation of, hey, what is best for the long term? We're going to negotiate with the seller to pay some of this. So how are we getting this to where the deal works for everybody, to where you're comfortable with the payment, to where whatever, right? Or in most cases where the underwriter's comfortable with the payment as well. So using that seller credit to that advantage and is the point right now. Very much the point.
You mentioned the underwriter. For our wonderful listening audience, can you just briefly go over who you are, your role, the underwriter?
So I'm a loan originator. We're a mortgage brokerage, which means we don't loan our money. We have multiple lenders, up to 35, 40 lenders that we can deliver a loan to. I mean, there's a lot of go down that rabbit hole a little bit further, but suffice it to say that Fannie Mae and Freddie Mac, or Ginnie Mae, which is FHA and USDA and VA loans, they're the agencies that actually own the debt. In the middle is what's called a servicer, okay, and that's the person you get your monthly bill from. And then there's the loan originator, and that loan originator, in our case, is different than the servicer who's going to sell the loan, versus if you walk into a big bank, enter a name here, they are both the originator and the servicer. Okay. So I'm the originator. An underwriter works for the bank, and what they're doing is making sure that the loan meets the guidelines set forth by the investor, in this case, Fannie Mae or Freddie Mac. So everybody has the same rules. Doesn't matter if you go to your credit union, your bank, your broker, doesn't matter who you go to, the rules are the same as long as it's a non-jumbo loan. Jumbo in our area is 647.2 and above.
So if somebody is financing if they get a loan, they can buy for $1 jillion. But if their loan is $642,000 and whatever you just said, $1 below that, they can get what's called a conventional loan.
Conventional, yep.
And then $1, that money, $647,250, whatever you said.
$647,200, yep.
Thank you. Or above, they're in what's called jumbo. Mm-hmm. Can you go over those two different loan?
Yeah, so like we talked about, below that limit is all set and defined. All the rules are the same because they're set and defined, and there's a fallback to the agency of Fannie Mae, Freddie Mac. Above that, I wouldn't call it the wild, wild west, but one bank will have a different set of rules than another bank. They're very similar, but there's some differences. And so you might walk into Wells Fargo versus Bank of America versus KeyBank and have sometimes large differences, sometimes small differences, not only in interest rate, but also in what rules they will have. So let's go back to March 2020, when our reality changed and COVID hit and we realized we're going to be in lockdown. What ends up happening in a scenario like that is that the investor for the private money jumbo loans no longer knows where things are going. They're afraid of what their investment's going to be. Their crystal ball is now officially broken, right? And so jumbo loans literally dried up in a span of like a week. There just wasn't anywhere to go with them. We're talking people in the middle of purchases.
Crazy
no longer
time.
No longer do you have a loan. Things just changed immediately. And then we had a benevolent big bank, with the horse and carriage, that came out and said that they'd be happy to do your jumbo loan as long as you had $250,000 liquid with them. So in other words, hey, thank you. And for the people that had that ability and had the money and had a relationship or were willing to change and make a different relationship in their banking, they could go out and get the jumbo loan. But pretty much the rest of the market dried up. And, a few months later, it all came back. But it's just when you don't have an agency behind it, it's a little bit more susceptible to the outside world. Right now, jumbo interest rates are much better than interest rates on conventional conforming loans because, remember, these big banks, they're using it as a tool to get relationships. They want people in there with their money, and then they can do what they cross-sell, right? Now they're going to get you in touch with their investment advisor group. Now they're going to do this, they're going to do that, right? And obviously, they've got their tools available to them. This is one, and it's wonderful. I mean, if you're willing to change and shop your banking relationship, there are some deals to be had in that regard.
What would be the advantages of going with a mortgage broker versus going with a bank, besides this jumbo loan thing where, they maybe have a relationship already and they're going to get a great rate? But what would, like, a regular, buyer coming in, tell me the difference for our listeners.
And I'm glad you brought that up because it's one of the big things that we're really trying to push and get out to people right now. It isn't about selling us. Again, it's a math and facts scenario for us. It's about that we want everybody to be shopping their mortgage. We want everybody talking to multiple lenders to get a feel for what's available to them. And here's why. We're in desperate times right now in the mortgage industry. The demand has fallen off. The production, each individual loan officer and industry as a whole has fallen off a cliff somewhere around May. And there's some desperation. And a lot of these companies, and if you're not seeing it now, you will be seeing it shortly, or you've got to look for it a little bit. There's lenders consolidating, going out of business, mortgage companies deciding not to be as heavily involved, Wells Fargo issuing a statement that they're pulling back. One of the largest leaders in the history of mortgages since I've been around is now saying they're reducing their footprint in the mortgage space. And so there's desperation. The problem is that when you are pricing a loan, it's always been over time, you could shop that loan around and maybe it would be a quarter point difference, maybe from 6 to 6.25 across the whole spectrum. On October 13th, I called 8 people in the Portland metro area that I've worked with in the history of my 20-year career, people I know, like, and trust, really good humans, right? The interest rate available on that day from those various different platforms was a difference of a high of 7.5 and a low of 6.75. So 3/4 of a point difference available for the very same loan for the very same fees.
That's
And
huge. That is so big.
It's a giant difference. And in this time where people are starving and getting out of business, people got to pay for their executives, all these things got to happen in the price of that loan. It behooves the client to shop. So here's where the rubber meets the road on that. For the same payment, that buyer had a $700,000 loan, which is not unfathomable at this point, right? $700,000 loan for the same payment, it's a $51,000 difference in buying power. So instead of buying a $700,000 house, they're buying a $750,000 house for the same monthly payment.
For the same payment.
Number one, if I could just get the message out, even if you're talking to me, shop your mortgage, get two or three at least quotes. Talk to your bank, talk to your credit union, talk to a mortgage broker, compare. There's a few different things that you got to think about as well. Price isn't everything. Can they get it done? What's their history? Who's telling you that they're worth their weight? How do you feel about them? Are they doing the right thing? Are they responsive? All those other customer service issues come into play as well. But number one, it could be a very large difference for you over time.
Besides the buy downs in the current market, and we just went over, mortgage broker versus like bank and shopping your loans, what else are lenders doing for buyers that maybe we haven't seen in a while? I'd like to hear, like I was thinking, I wonder if people are doing bridge loans again, or what they're doing to try to entice buyers or make them feel confident in this market where, one, we have low inventory, and two, they might not sell their home as quickly as they need to buy the home that they want. So I'm curious, Todd, what are some of the programs that you're offering with buyers to help them in this time?
The biggest thing that we're trying to do is use the tools at hand. There aren't any real new ones, right? Mm-hmm. But we had talked about the permanent buy down. Now there's the temporary buy down, which is a 2-1 buy down, and just, go down that rabbit hole for a minute and then come back to the rest of your question. The 2-1 buy down is temporary payment relief. So on a 2-1 buy down, when we look at that first number 2, that means the first year of that loan, your interest rate is 2% lower for that 12 months. And then the next year, the second year, your interest rate would be 1% lower than the note rate. And then the note rate from year 3 through 30. Okay. So let's say it's a 6.99% interest rate. The first year, your interest rate is going to be 4.99. Second year, it'll be 5.99. Third year, it's 6.99. The thing about this program, it's a seller paid program. We have to get contribution from the seller towards that money. And all the seller's doing is paying out the interest difference. The lender is going to hold that money. They're not going to apply it to the loan and magically it just lowers your payment. They're holding it in your escrow account and applying it every month they're basically subsidizing your payment for that time accordingly. Okay. So what happens going forward with that money is let's say you refinance before that money's all spent. That money is going to be applied towards your principal balance on your loan. So as you pay it off, you win the lottery, you pay it off, your principal balance gets that money absorbed into it. It benefits the buyer over time. But right now, when we talk about that payment plan, the payment being the issue, the payment being the pain point, we look at this and we say, okay, here's one way to make that payment less for a time. That's a tool that can be used, Audra, like you ask in that scenario. Well, I've got a house that's not selling. How am I going to be able to afford these 2 house payments? Well, this will help. I don't know that it's going to get you there. Right.
What's the difference between that and an adjustable rate mortgage?
Yeah. So an adjustable rate mortgage says that your interest rate is going to be fixed at a lower interest rate, a starting interest rate for a certain amount of time. And the way we read those, we say a 1-1 arm. A 1-1 arm just says the first year that's at whatever interest rate the starting rate is. And then every year thereafter, it will adjust. So the 1 and then the second one is how often does it adjust. So when we get into something like a 3-1 means first 3 years it's fixed. Second number tells us every year, once a year it adjusts. If you look at something and it says a 3-6 or a 5-6, that just means, again, first number is how many years is it initially fixed, and then it's every 6 months. So biannually it's going to adjust, and every time thereafter. ARMs have come back into favor, and they generally do when you believe that going down the road, interest rates are going to be better. The problem I'm having with ARMs is this. At the beginning of this year, NAR, Fannie Mae, Freddie Mac, every prognosticator you had in the world was telling us that interest rates would not be higher than 4.75 right now where we sit today. So the same people are telling us that down the road these interest rates are going to be better, and I got to believe that they know what they're talking about. But I'm pretty sure that from what I can tell from the recent past, their crystal ball doesn't work any better than mine. So
It's cloudy.
so yeah, so for that reason, I like a fixed rate product with a buy down, with a temporary buy down, something to get you to that bridge, but doesn't leave you holding the bag if another pandemic breaks out or whatever we've got on in store for us coming down the road. So again, if we go forward and we end up in some level of recession, and we could either be there or not there, depending on who you're listening to in the media today.
That's right.
Right. But
Right.
down the road, that is generally better for mortgage rates and generally something we can see an opportunity to take an advantage of a refinance or something like that down the road.
You brought up the word bridge, and I'm curious. Are those loans back? Is anyone doing those for the market?
So there are bridge loans out there. There's also cash buying loans. So you can buy a house with cash. Say you're in a competitive situation. You can buy a house. The lender will give you cash to buy the house and then refinance you into your permanent financing within 2 weeks. We could go into a multiple offer situation with a cash loan. And we can buy this house with cash and then refinance you into your mortgage. There are lenders out there, and I'm not one of them. There are some out there with a bridge loan that will pair with that cash. But in a depreciating housing market, you've got to ask the question about how long do we think these items are going to be available. So if a house is going to sit there on the market, that bridge loan is very much less attractive than it was 6 months ago for an investor. The cash program as well, if we're buying a house that was worth this today but we're depreciating quickly, if we get to that point, I would imagine that those two things are going to dry up and blow away pretty quickly. Going back to your question about a bridge loan, it's really a fancy name for some sort of home equity line of credit, some sort of home equity loan. A bridge loan is specifically tied to the fact that the new lender acknowledges that you own this old house and wish to sell it after closing, versus a regular home equity line of credit would not want you to be selling that house. They would want the loan to be there. So for the bridge loan, generally there's going to be some extra fees because they're not going to make their money on interest over time. They need to shore up their costs for that loan. There are some bigger lenders in the area that had them recently as this summer, but obviously with the less competitive house market and the less multiple offers, their necessity isn't quite the same as it once was.
I remember we've done a few with some clients in the past. And one of the things that I do like about bridge loans is that if a house pops up, so sometimes we have families that are moving, their kids are growing and they need a bigger house. But their day-to-day life is not, oh my gosh, I've got to get my house ready for the market. We have a lot of people in this boat that they're thinking, if something comes up, I will see. I personally try to get them ready. So I do a lot of pre-work on their home. I've got a gal, we've painted, we've done new carpet. Now we're in a holding pattern. But the thing that I like about them is for a team that helps sell and buy, is that we can get them into the home. If that home pops up in the school district that they want and the size works, we can get them into that home, and then we can vacate their home and stage it, get it ready so it hits the market looking super fresh, and go for selling it then. I love that option because it's hard to get your house ready for a market.
Think about all those stressors of moving, right? I got my degree in psychology, which was forever and a year ago, but they had the diagnostic statistical manual that outlined all these. And moving, on the top 10 list of stressors, moving has 3 of those items. Right?
Yeah.
Generally, it's coming with a job change. It's coming with a school change. Think about all those stressors, right? And then you add to that a time frame. Hey, you got to be out of this house and into that house and have a cleaner through and do this and do that. To remove that stress, that's the beauty of a bridge loan and the people that have the wherewithal to do them. The downside of them is if the house is going to sit for a while and they got to carry 2 payments. These are just the realities. I think everybody should be allowed to move into the house first and sell the house second, just because the stressors are just phenomenal.
Exactly.
So
it really is. And, doing this for 20 some years, that is the biggest, one of the biggest obstacles that folks have to come to terms with when they're getting ready to sell their house. How do they not only get it ready, but then add in everything else and then try to keep your house looking amazing for every showing? And you want to take every showing because, okay, fine, they're going to come at dinner time. Great. I've got pasta cooking on the stove we got to clear out because you want to sell your house. And
God forbid you have a pet.
right? And we were in this luxury market for whatever, 12 months. I don't know how long we were there, where the sellers called every single shot. They were saying, you do this and you do that. And the buyers were thankful and they were happy. And we said at the time, where are all the mortgage brokers that are coming with the cash loans? Well, they came at the end because it's hard to move and turn that ship. And the last call I got, I was like, oh my gosh, you know what? That ship is like, maybe we'll need you, but it's a little different now.
Where were you 12 months ago?
Yeah,
buddy?
I was like a little late to the party. And we're like, we're close. We're wrapping up. It's like last call.
Yeah.
And in a very short period of time, it really switched and turned. And I am now seeing houses that are sitting, and great houses that are sitting that shouldn't be sitting. Things move quickly, and I don't know what's going to happen in the future. I don't know if it, if they're predicting what you said and interest rates are going to level off, or even you said in the last 24 hours you've seen a drop of 1/4 of a point, or that's a great sign. And all of these programs, is there any programs that we did not talk about that you're offering buyers right now in this market for loans?
There aren't a lot of new and exciting things, right? There's a lot of rehash of the old things. Right now, I think the biggest thing that we're pushing is buyer education, getting people to know what they're getting into, getting them educated, understanding that your lender, who are they working for? Are they working for you, or are they working for the bank? Really, my thought in this process and where I want my legacy to be when people are saying nice things about me over a hole in the ground is going to be, he really was doing right things for other people. Right. And so we look at this situation and we say, okay, helping people understand, because of that, we talked about earlier about the desperation right now in the mortgage industry. So to belabor that point just a little bit, when your credit report is pulled, and this goes back to the opt-out pre-screen thing we talked about earlier, when your credit report is pulled, I don't know if it's Equifax or Experian, one of the two E's, will sell that information to lenders, not your personal private information, but your phone number and your email address. And they will sell that to mortgage lenders saying, hey, they just had a credit report pulled by a mortgage lender. And then literally what we're getting from some of our clients right now is that their cell phone is inoperable for the next 24 to 48 hours because of phone calls flooding in. So, I'll think about all those people that advertise on the Super Bowl for mortgages are hammering your phone right now. And they've got, and they're not necessarily looking for your best interest. They're looking to make that sale. They work for the bank. They are going to make their commission. It's not about what's right for you. It's just trying to trick you into getting into that. So we talked about the difference in available interest rates. They're at the higher end of that, but they know that people don't necessarily understand the interplay between rates and fees. And so they're saying, well, our rate is this, and kind of leaving the fee out of the conversation when the fee is triple what you would be paying somewhere else, or even to the first person you talk to who pulled your credit report in the first place.
Just to follow up, you mentioned earlier, Todd, shopping around, getting other quotes, which I love, and I appreciate you saying that. One question we all have at some point is, how does a potential borrower do that? And my question is does a borrower need their credit pulled to get the answer about how much you guys can quote somebody or the other lender? And then the last question on that thread is, how many times can one have their credit pulled before having an adverse effect on their credit?
So let's answer the credit question first, because there's a lot of fear and misinformation around that. What you don't want to do is go out and have 30 people pull your credit report. You just do not want to do that.
That's what I thought.
So we advocate for, and again, we're not paid anything, and they could screw up tomorrow, and I'm going to distance myself from them. But myfico.com is one of the places that you can go to sign up for it and pay for a monthly service. But it not only gives you your credit score for credit cards and auto loans, which is FICO Model 8, but it also gives you an option to look at your mortgage scores, which are FICO Models 2, 4, and 5. They're different. Your credit score, I bought a car last month. My credit score was 890. Well, ours only goes to 850. So that's a different model than we're looking at. So,
Right.
So I would say number one is be educated on what your mortgage score is. The second thing is I would do the opt-out pre-screen so I don't get hammered by a bunch of unwelcome, unsolicited phone calls from people I can't know, like, or trust because they're just not simply any of those topics. The second thing would get referrals from friends and family, from my realtor, from the professionals around me, and speak with several of those people because you know that they've got some level of competence and history to back up who they are. Another step would be educate yourself on how mortgage pricing works. Now, you know your score, you're equipped, you call these people and you say, hey, I'm looking for exactly this. And you get it from 3 or 4 or 5 different people, and you want it to all be in the same range. Because remember, if you shopped me yesterday and today, the market overall is 0.375 better, I'm going to look like an idiot compared to the worst price lender you speak with today.
This is the thing I hear is so-and-so got me a better rate. I'm like, well, did you talk to him at the same time, or did you talk to him at different points?
I spoke with him 3 weeks ago, and
things change every day.
Well, I'm just saying now you're equipped, right? Now you can make an educated decision. And then find somebody, and I would say, overused term is fiduciary, but who's working for you? Who's helping you understand the information? And, and we'll give out, and I don't know how we do a link to our website here, but there's an educational forum there. We don't track you. We're not going to call you. We're not going to anything. Get in there and get deep on some of the information because it's really going to help you understand what you're doing, even if you don't use us.
We will have links in the show notes.
This is a business, and we're seeing this with iBuyers and some other places that are pulling out of the market because real estate is a really interesting area. It's an emotional purchase for people. The regular residential purchaser, it's an emotional purchase. They find a home they like, they find a neighborhood they like. Yes, we want to help you build wealth. We want to help you buy that first home because you're going to pay rent or mortgage, whatever you want to call it, somewhere. So why not make it work for you in the future? But let's say you find a mortgage broker and you do your 3 or whatever you feel like running the rates against, but you find the one that you really like and you think, well, I really want this person on my side. I feel like they're a good fit, but their interest rate is a little higher. Do mortgage brokers, do they have the ability to match other rates so that they can work with you?
It's a two-folded answer. Okay. And I know that sounds slippery, but here's the truth to it. As a mortgage broker versus a mortgage banker, so somebody who works for the bank is a mortgage banker. I'm a mortgage broker. I've got 40 different lenders we work with, right? That's the difference. My income is capped, is number 1, capped, number 2, transparent, number 3, non-negotiable. I can't give it away. I can't take lower for you than I can for her. I can't change it. I just have to give my best price every time. And that's what we do, right? At the bank, they have a little bit more flexibility. We still have all the same laws, but for some reason, a lot of these banks have decided that they can be a little bit lenient on this or not another. This is all part of Dodd-Frank, by the way, that was passed in 2010. This isn't us deciding to do it one way and them deciding to do it another. We're all supposed to be doing it the same way. But their team of lawyers have decided that it's okay to do it this way. And we just, we're a 14-person company, so we just go by the law. It is what it is. That being said, the answer is they're not supposed to be able to, but they will. And it is a strategy, believe it or not, in this wonderful mortgage industry that we're in, for people to quote a higher rate. And then when they find out you're shopping, lower their rate. And my answer to that one is always, are we buying a car here or are we getting a mortgage? Because, if they have to say that I'm going to go talk to my boss about this and they're going to win your business by coming down, where are they going to be next week when you're not looking?
Is that why there's such a range on some of these interest rates when you...
Yes, indeed. Indeed, 100%. Now you're seeing the full picture, the dirty, seedy underbelly of, you come in and I'll get you at this rate, and if you're savvy, I'm going to lower it to this and still try and get you. And then when you're not looking, we're going to go back up to that. And, because I've won your business through the initial round of interviews, right? And then 2 weeks from now, you find the home and you got to get that pre-approval letter. Hopefully I'm still being honest.
Straight up. One thing listening to you, now I'm in these conversations all day long, but not everybody is, because this is all I do. Everyone else is at their own job. You said the website that one could subscribe to or sign up for to get their mortgage score was?
MyFICO.com.
How is FICO spelled?
FICO.
Thank you. And then what was the opt-out thing?
It's optoutprescreen.com. And the key thing there is you're putting your phone on a registry, and it's pulling it out to where our friends at Equifax can't sell your
There we go.
optoutprescreen.com, and
Perfect.
all the other information. Todd they have a great website, vantagemortgagegroup.com. There's plenty of videos and all kinds of great
So much
information and
information.
resources there for free.
Oh my God.
All for free.
Yeah, we're not going to chase you around or anything.
You're here,
So-
like you said, you're about the facts and the math and
Facts and
buyer
math.
education. Math and
Numbers.
facts.
I think the only reason that I would not use Todd is because he wouldn't have the program I needed. Like if I needed a commercial loan or, that's the only, he's limited to what he can lend on.
Let's get real transparent about that real quick. Right now, if you're out looking, and I'm talking today, November 10th, right? 2022, big banks are going to have the best jumbo rates. It's just what it is. It's just where they're at. When we're looking at commercial loans, those are a specific product. Rehab and construction loans, we have some access to some of them, but once again, there are specialists out there that do that. When we're looking at VA veteran loans, by the way, one of the biggest spaces where people are targeting a subset group of people and not being competitive. They're going on a false trust and taken advantage of. That, if there's one group in this world that I could say is an absolute must, has to shop their rate, it's veterans, because there are some real sharks in that tank, and some of them being ones that profess themselves to be the friend of a veteran. So it's very
So
disturbing.
disheartening.
We do veterans. We do very well at those as a broker. That's one of our niches. Anything conventional conforming, FHA, VA, USDA, all that's very much in our wheelhouse.
My takeaway from this whole thing is that 2-1 buy down, I really think that's a strong option that I wish there was a better way to explain it to people, that it was easier to consume and internalize for folks, is a little bit of best of both worlds in terms of you're not stuck on the 5-year arm where you are exposed to future craziness. I think I agree that it seems like late next year, things are going to stabilize and maybe go down, hopefully go down. But we all know no one knows. And in 3 years, if interest rates are much higher, the world doesn't go according to plan, these people could lock in a rate today. Future us might think 7% is wonderful if it keeps going up. I don't think anybody in late 70s saw it going up to, I don't remember what it peaked at. Was it 17%?
18, 19,
17, yeah.
I don't think anybody 2 years before that thought, oh, yeah, that's what's going to happen. I could see it clear as day. But with the 2-1 thing, get your legs under you, have 2 years of the payment being what you can do. And then in year 3, A, interest rates go down, you refi to a better rate. B, you're stuck with this might be a wonderful 7.5%, 7% rate, which, I can't believe the words out of my mouth are coming out, or that I could maybe believe them, which I don't. But future us might look back and, who knows? Audra and I got our first mortgage at 7.25% in 2002, and we were pinching ourselves, couldn't believe what
You
a
were
great
thrilled.
rate. Who knows?
That's right.
It's not. So you're telling the newcomers into this whole world, it's not impossible. It's just going to be something you have to get your education, be patient, talk to people like Andrew and Audra and Todd, for sure.
Well, get seasoned people on your side, because people come in and out of all kinds of jobs, in and out, and you have to put the time in and the hours in to really have the experience. And when it comes to purchasing a home, unlike a car where your loan is over in 4 or 6 years, whatever program you take, this is a commitment. And what Andrew and I try to do with people like Todd is set up everybody to feel good, that they got a good program, they've got a good loan, they've got a good home. New home buyers to help start building that wealth for them. And then everyone else just get their needs met and do it with a team that knows what's going on, has seen the ups and downs, been there, has the experience to back you.
Stick with the seasoned. Little salt, pepper, garlic, the whole thing.
Yes,
Yeah,
Yes,
definitely.
especially in these autumnal times. I'm ready to cook. It's a beautiful
Get
fall.
some chili going.
Our roasting thing.
Right.
Well, Michelle, thank you. Todd, thank you.
Thank you
Thank you for
guys
having me.
very much.
Thank you, Todd.
In the
Perfect.
meantime, have a wonderful Thanksgiving, everybody.
Yay. Thank you. You too.
Grateful
Happy
for all of you.
Thanksgiving.
Thanks for listening to the Portland is Home Team Talking Real Estate podcast. For more info about Audra and Andrew, finding your next home, or selling your current home, visit their RealtyWorks website at realtyworksgroup.com. If you like what you heard, be sure to subscribe on Apple, Spotify, Google, or wherever you get your podcasts. For help with your podcast, find us at Modcast Productions or modcastproductions.com.